Charge going up, fire in the hole, go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to break down 3 important terms that describe the health of your trading account: balance, equity, and margin calls. These numbers are the lifeblood of your trading account. Understanding them keeps you from being blindsided by forced liquidations or unexpected losses. Let's start with your balance. Your balance is the total value of your account after all closed trades. It does not include your open positions. Think of it as the snapshot of your account if every trade were closed right now. For example, if you deposit $5,000 and close a trade for a $200 profit, your new balance would be $5,200. If your next trade loses $200 and $100, your balance drops to $5,100. Simple, straightforward. Balance reflects realized gains or losses only. Now let's talk about equity. Equity includes both your balance and your open trades, meaning it's your real-time account value. Let's say your balance is $5,000 and you currently have an open trade that's up $300. Your equity is $5,300. If that trade goes negative $200, your equity falls to $4,800. As your open profits or losses fluctuate, your equity moves with them. This number constantly changes while you're in a position. Understanding your equity is crucial because it determines whether you have enough available funds to open or maintain additional positions. That brings us to margin, and more specifically, margin calls. Margin is the money your broker sets aside from your account as collateral to keep your position open. It's not gone. It's just locked up while your trade is active. The rest of your balance is what's called free margin, meaning available to open new trades or absorb losses. A margin call happens when your equity drops below the required maintenance margin set by your broker. Here's how it works. Imagine you have $2,000 in your account. You open one NQ contract that requires $500 in margin. That leaves you with $1,500 in free margin. If the trade moves against you by $1,500, your equity falls to $500, equal to your margin requirement. If losses continue even slightly, your broker will automatically close your trade to prevent your account from going negative. That's a margin call. Brokers don't ask for permission. Once your equity drops too low, liquidation is instant. This protects the broker, but it's devastating for traders who don't monitor their exposure. The rule to remember is simple. Always keep a safety cushion. Don't use all your margin at once. Keep enough free margin to handle drawdowns. Professionals rarely use more than 20 to 30% of their available margin at a time. That leaves room for volatility and keeps their account safe even when trades go temporarily against them. Think of your balance as your foundation, your equity as your current position in battle, and your margin as the shield that keeps you in the fight. If that shield breaks, the market knocks you out. Monitor these numbers constantly. Make it a habit every time you open a position to know your account balance, current equity, margin used, free margin remaining. If you understand these 4 figures, you'll never be surprised by a margin call or forced liquidation. In the next lesson, we'll shift from account mechanics to price structure, understanding how the market moves, what defines a trend, what defines a range, and how recognizing these patterns gives you the tactical edge in every trade. Now let's talk about position sizing, because even the best stop loss won't save you if you're trading too large. The rule is simple. Never risk more than 1 to 2% of your total account on a single trade. If you have a $5,000 account, risking 2% means your maximum loss should be $100 per trade. Work backward from there. Divide your dollar risk by the tick value to figure out your stop size and number of contracts. This ensures that no single trade can wipe you out. Remember, trading is a game of probabilities. You're going to take losses. That's part of the business. Risk management ensures that no single loss is large enough to matter. When you control risk, you control your emotions. When your emotions are under control, your decision making becomes sharp and objective. That's what professional trading looks like. So before you enter any trade, ask yourself 3 questions. Where is my stop loss? Where is my take profit? How much am I risking in dollars? If you can't answer all 3, don't take the trade. In the next lesson, we'll go deeper into how your account value changes as trades open and close. We'll explain the difference between balance, equity, and margin calls. and how to keep your account healthy and safe from forced liquidation.